Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. One of our clients recently showed us a variable annuity he was seriously considering. On the surface, it looked like it was a good idea for him. However, this video will reveal the big issue which lay beneath the surface, and it will provide other suggestions which might be helpful if you are considering annuities for your own financial planning. Annuities have a reputation for hidden costs. So when our client said he had found a variable annuity that looked good to him, I was skeptical. He was considering a 3-year investment of $1 million with these terms. The annuity would earn 100% of any gain in the S&P 500 index if it went up. And if the S&P 500 index went down, our client would have protection. He would only begin to experience losses once the S&P 500 fell by 20% or more. That full upside participation, combined with meaningful downside protection, was appealing. But was there a catch? This chart shows the economics of the annuity as presented to our client as compared to the economics of investing $1 million directly in the S&P 500 stock index. So the x-axis here is the price of the S&P 500 index 3 years from now. If the index rises, the annuity would trail the S&P 500 by about $35,000. That's 3 years of dividend income that our client would forego. But in a severe bear market, the downside protection could save as much as $165,000. Looking at this comparison, it's understandable why our client thought investing in the annuity might be a better choice for him than investing in the stock market index. Since our client liked the payoff profile of the annuity, we thought it would be helpful to re-engineer it to show how he could create the same profile directly for himself rather than obtain it through the insurance company. To do that, step one is to buy call options at the current index level to capture all the upside, and that costs $171,000 for $1 million of calls. Step two is to sell put options at 20% below the market to set the point where losses begin. And then step three is to take what's left from the initial $1 million, which is $876,000, and buy a 3-year corporate bond paying 4.5% per year. The payoff in 3 years from the annuity and from this build your own strategy are shown on the chart. You may not be able to see that there are two different lines on the chart because payoffs are the same. So following the steps I just described, our client could build his own strategy and end up with the same investment outcome as the annuity before taxes and fees are considered. But what about those fees? In this case, they were significant. The fine print in the prospectus indicates that the upfront fee to the salesperson could be as much as 7%. Moreover, there were annual fees of nearly 2% per year. In the box at the bottom here is language copied from the documentation provided by the insurance company. This language acknowledges that the salesperson faces a conflict of interest. The large upfront commission provides the salesperson with a compelling financial incentive to recommend the annuity to you, even if it is not really your best option. So let's look at how the large fees change the payoff. In this case, I applied 6% upfront fees and 1.8% per year, and that creates 11.4% in fees overall. So that would be $114,000 of our client's $1 million that would be gone for sure before the stock market moved a single point. These fees shift the payoff profile of the annuity to the lower line in this chart. After fees, the annuity will always be quite a bit worse than the do-it-yourself option and also will be quite likely to underperform the S&P 500 index. The fees are the major issue with annuities, but that's just the beginning. If you are seriously considering annuities, you should also understand the tax treatment, the illiquidity, the complexity, and the counterparty risk. To sum up, while many annuities look appealing on the surface, they can become unappealing once fees and other terms are considered. Secondly, if you like the payoff profile of an annuity, you probably can create that same profile for yourself directly at much lower cost. Furthermore, it's essential to dig into the fine print to find out what you're really paying Finally, it can be worthwhile to do what our client did and check with an independent, registered investment advisor like Atlas Capital, where the advisors have deep knowledge about structured financial products and are also required by law to provide you with advice that's in your best interest. So, thanks for watching. If you've been shown an annuity and want a second opinion, reach out. We'll be happy to run the numbers. Thanks.